Hello there, investors, and welcome back to our channel. Today, we're demystifying the world of bonds, shedding light on their essence, and exploring the potential advantages they hold for your investment portfolio. Bonds may seem enigmatic, but fear not. By the end of this video, you'll have a solid grasp of what they're all about. The basics of bonds. So what exactly is a bond? At its core, a bond is like a loan granted by an investor to either a company or a government entity. These entities issue bonds to raise funds, and in return, they commit to paying interest on the borrowed amount. It's essentially a win-win situation. Why bonds matter? Why should you care about bonds in your investment portfolio? Well, bonds are often seen as a less volatile option compared to stocks. They offer stability and can be a great way to diversify your investments. The bond scenario. To illustrate this, let's consider a scenario. Imagine the city of Fairview wants to build a new baseball stadium. To fund this project, they issue bonds. Each bond is a $1,000 loan with a 10-year term and a 5% annual interest rate, also known as a coupon rate. An investor buys the bond for $1,000. Over the years, Fairview pays the investor $50 annually in interest. At the end of the 10-year period, the investor gets back the initial $1,000 principal investment. This setup benefits both Fairview and the investor, as Fairview gets the funds they need for the stadium, and the investor enjoys periodic interest payments and the return of the principal. Bond advantages. Bonds offer scheduled payments and principal reimbursement, making them more predictable and stable compared to stocks, which can be influenced by market dynamics. Bond risk. However, it's not all smooth sailing with bonds. They come with their own set of risks. One such risk is default risk, which occurs when the issuer fails to repay the principal. The level of risk depends on the financial stability of the issuer. Governments are typically considered stable issuers, while corporate bonds can carry higher default risk due to the potential for corporate bankruptcy. Understanding rating agencies. To gauge the financial health of issuers, credit rating agencies assign ratings to bonds. These ratings can be helpful, but remember that they are not infallible, so thorough research is crucial before investing. Interest rate risk. Another critical risk is interest rate risk. If interest rates rise, the value of bonds sold before maturity can decrease. Investors might be tempted to switch to bonds with better rates, potentially selling existing bonds at a discount. Remember, smart investing can help you build wealth over time.